Every ETF grows your money. That's the easy part. The hard part is finding the one that grows your money and pays you more per month than most people earn at a full-time job, on 50 grand, invested once. In this video, Josh takes the most popular ETFs investors reach for first and puts them all through one filter. Can this fund replace a full-time income from a single $50,000 investment with nothing else added? Most of them do not make it past that line, but one does. And by the end, I will show you how that one ETF on a single $50,000 investment is projected to reach a $2 million valuation and pays over $8,000 in monthly dividend income. Josh starts with the goal: one ETF that can replace a full-time income from a single $50,000 investment. No extra contributions, just the money, the fund, and time. That sounds simple until you realize what it actually requires. The ETF cannot just grow the account. It has to pay a dividend, grow that dividend every single year, and do both consistently enough to compound over a long horizon without falling apart. Most ETFs are not built for that. Most ETFs are built to make your balance bigger, and a bigger balance that does not pay you anything is not income. It is a number on a screen. So he starts with the names everyone knows, the ETFs with the biggest followings, the heaviest trading volume, the ones that show up first in every search result and every recommendation list. If any ETF can do this job, it should be one of these. And the most popular name on that list is hard to ignore. QQQ, the NASDAQ 100, one of the most traded ETFs in the world, and for good reason. It has produced extraordinary returns over the last decade. Millions of investors own it. But the dividend yield is 0.48% with 0 consecutive years of dividend growth. No yield, no growth in that yield, no streak of increases. On 50 grand, that is roughly $240 a year today. But the bigger problem is that number has no engine behind it. There is no history of that dividend getting larger year after year. Without dividend growth, the income in year 1 is roughly the same as the income in year 20. QQQ is a great ETF for building wealth. It is just not built to pay it back. So what about something built closer to the same space but with a dividend focus? VGT, Vanguard's technology ETF. Same space as QQQ, different provider, so it seems like a reasonable place to check. But the dividend yield is 0.43% with 0 consecutive years of dividend growth. Same problem, exceptional price appreciation but no income engine underneath it. Price appreciation does not pay the bills unless you are selling shares, and selling shares is not the plan. Two of the most popular ETFs in the market, and neither one has the dividend growth to do the job. So what happens when you step outside of tech entirely? VOO and VTI, the Vanguard S&P 500 ETF and the Vanguard Total Stock Market ETF. These are the two funds most people hear about first, the default recommendation anytime someone asks where to start investing. And they are good funds. VOO yields 1.18% with a 6.07% 10-year dividend growth rate, and VTI is nearly identical at 1.16% and 6.34%, so close that they are almost the same fund for this purpose. This is the first time all three pieces show up: a yield, a growth rate, and a real track record. But the starting yield is still low. On 50 grand, VOO generates roughly $590 a year. Even with a 6% dividend growth rate compounding that forward, the income does not reach paycheck territory within a realistic timeline. The engine is there, it is just not strong enough. So what does an ETF actually built for dividend income look like? DGRO, the iShares Core Dividend Growth ETF. And this is the first one that actually feels like it belongs in the conversation. It carries a 2.09% yield, an 8.91% 10-year dividend growth CAGR, and 11 consecutive years of dividend increases, a stronger starting yield, a faster growth rate, and a proven streak. This is not a growth fund pretending to pay income. This is a real dividend growth fund with a real engine. But there is an ETF on the list with a higher yield, a faster dividend growth rate, and a longer streak of consecutive increases, beating DGRO on every single metric that matters for this goal. DGRO is a good fund. It is just not the best tool for this job. One fund survived every check. SCHD, the Schwab US Dividend Equity ETF. SCHD tracks the Dow Jones US Dividend 100 Index, 100 companies selected specifically for dividend consistency, financial strength, and sustained dividend growth. This is not a broad market fund that holds everything. It is not a tech fund chasing price appreciation. Every company in this index earned its spot by doing one thing, paying a growing dividend and doing it consistently. Across those 100 companies, SCHD blends out to a 3.45% dividend yield, a 10.43% 10-year dividend growth CAGR, and 14 consecutive years of uninterrupted dividend growth, the highest yield, the fastest growth rate, and the longest streak of anything Josh looked at. That combination is exactly why everything else got ruled out first. Knowing what a fund is designed to do and knowing whether it has actually done it are two different things. Josh doesn't commit 50 grand based on a design philosophy. He checks the record. First, he wants to know what he's actually buying. SCHD holds 105 companies. The top 10 make up 40.3% of the fund. Chevron, ConocoPhillips, Merck, Verizon, Coca-Cola, Texas Instruments, PepsiCo, Amgen, United Health, Procter & Gamble. These are not startups. These are companies that have been paying dividends for decades through recessions, rate hikes, and market crashes. The sector breakdown tells the same story. Healthcare at 18.78%, consumer defensive at 17.89%, energy at 16.83%, and technology at 14%. No single sector dominates. If energy pulls back, healthcare carries it. If tech struggles, consumer staples hold steady. That diversification is not accidental. It is built into the selection criteria of every company that makes it into these 100 holdings. But holdings and sectors are just the design. Josh wants to see what the fund has actually paid. Every quarterly dividend payment from 2017 to 2026 is on screen, bar after bar, trending upward across the entire chart. Not a single gap, not a single cut. Through 2020, when companies across the market were suspending dividends to survive, SCHD kept paying. Through 2022, when the broader market pulled back hard and investors were panic selling, SCHD kept paying. 14 years of uninterrupted dividend growth. And the price has kept up. 1 year, up 9.65%. 5 years, up 23.47%. And that 5-year chart is worth pausing on, because 2022 is right there. The dip is impossible to miss. The whole market pulled back, and SCHD pulled back with it. Then it recovered. Then it kept climbing past where it was before the drop. That is exactly what a long-term investor needs to see. A fund that absorbs a real drawdown and comes back without requiring a single decision. 10 years, up 128.86%. The share price more than doubled in a decade on price appreciation alone, before a single dividend payment is counted. Then two final numbers. Since its IPO in 2011, SCHD is up 267.01%. And the volatility tells the rest of the story. SCHD moves an average of 1.6% per week. The broader market averages 7.1%. That is less than a quarter of the market's weekly movement. For someone putting 50 grand in and not touching it for a long time, that matters more than most people think. Because volatility is what shakes people out of positions before compounding ever gets the chance to work. In a few minutes, you're going to see what 50 grand in SCHD looks like over a full timeline. Whether it reaches $2 million and pays over 8 grand a month, or stops at $600,000 and pays $2,600, depends on a single decision Josh makes before he buys his first share. On the brokerage platform, there is an option sitting next to SCHD. 4 letters, DRIP, Dividend Reinvestment Plan. Without DRIP, the mechanics are simple. SCHD pays a dividend every quarter. That cash lands in the account and sits there. It does not compound, it does not buy anything, it just waits. With DRIP turned on, every dividend payment automatically buys more shares of SCHD instead of landing as cash. Those new shares become part of the position, and those new shares pay dividends too. Next quarter, the position is slightly larger, so the dividend is slightly larger, so it buys slightly more shares. Quarter after quarter, year after year, the position grows automatically without Josh doing anything. DRIP does not change what SCHD is. It changes what happens to the money SCHD pays every quarter. Cash out or reinvest. That is the entire decision, and that one decision, made once on day one, is worth nearly $1.5 million. So what happens when Josh takes the dividends as cash and does not reinvest? By year 1, the portfolio is projected to reach $54,330, generating $1,725 in dividend income for the year, $144 every single month. By year 10, that balance is projected to reach $114,727, more than double the original 50 grand. The annual dividend income hits $4,266, $356 a month. Solid growth, but every dividend payment for the last decade has landed in cash and sat there. None of that money has ever worked a second time. By year 20, the portfolio is projected to reach $263,247, generating $11,665 in annual dividend income, $972 every single month, nearly $1,000 a month from a single investment with nothing added. That is real money. By year 30, the portfolio is projected to reach $604,033, generating $31,900 in annual dividend income, $2,658 every single month. $2,658 a month from a single 50 grand investment with nothing added. Those are solid returns. Most people would take that and never look back. Now, let's see what happens when Josh turns DRIP on and reinvests every single dividend. Same ETF, same 50 grand. The only difference is that Josh reinvests his dividends every quarter. By year 1, the portfolio is projected to reach $56,055, generating $1,725 in dividend income, still $144 a month, but this time it is reinvested. By year 10, the portfolio is projected to reach $160,900, generating $5,768 in annual dividend income, $481 every month. That is $46,173 more in the account than without DRIP, and $125 more every single month, purely from reinvested dividends compounding on themselves. By year 20, the portfolio is projected to reach $551,764, generating $23,413 in annual dividend income, $1,951 every single month. That is $288,517 more than without DRIP, nearly $300,000 extra from the same 50 grand. By year 30, the portfolio is projected to reach $2,039,993, generating $102,330 in annual dividend income, $8,528 every single month. Look at those two lines on the chart. They start at almost exactly the same place. By year 30, the gap between them is $1,435,960, nearly $1.5 million. The monthly income gap is $5,870 every single month for as long as the position runs. The median full-time salary in the United States works out to roughly $4,800 a month after taxes. SCHD with DRIP on a single 50 grand investment, no additional contributions, no monthly top-ups, nothing added, is projected to pay $8,528 a month by year 30, nearly double a full-time paycheck, from money Josh invested once and never touched again. Not everyone has 50 grand sitting around. If that is you, click the video on screen to see how a 2 ETF portfolio turns $10 a day into over $3 million and $6 grand in monthly dividend income.